Thank you very much, and thank you everyone for joining us today. It's been an exciting 12 months for us. We've been working on an acquisition in Canada for the last 12 months, and finally we've been able to announce it today. As many of you know, I actually will go to page 3 if you wouldn't mind. As many of you will probably know, we have an existing resource in Canada in the Montney. We drilled that 3 years ago. We spent around $60 million, and our objective originally was to prove up a very large gas resource or a liquids-rich gas resource in the Montney, an extension of the existing fairway, grow a resource to over a TCF of gas, and really participate in the revaluation of the natural gas cycle. Unfortunately, we're a few years too early. We thought with LNG Canada coming on board on the coast, that would change the gas market. But unfortunately, we had great technical success, but we didn't actually have equity market success for our shareholders. So we knew we had to combine ourselves with an operating cash flow business, and that's what we've done through the Black Spur oil and gas transaction. Black Spur is a company that's been around for over 7 years, founded by a gentleman called Jordan Keevil, and they are probably a top tier junior oil and gas company in Calgary. What they do for us is they give us rising exposure to the rising oil and gas market, and most importantly, a low cost production base. They've got a large reserves, they've got proven developed producing reserves of 5.4 million barrels. They've got 22 million barrels of 2P reserves, of which 65% is oil. And these complement our existing 2C resource sitting in the Montney of just on 190 million barrels of oil equivalent, of which 77% is gas. So what we've now built is, and through this merger, is combined a business with an oil focus today generating strong cash flow, with a very, very large gas resource sitting there waiting for the expansion of the LNG industry in Canada through LNG Canada and through other projects that are coming on stream over the coming years. As I said, one of the benefits of this transaction is Black Spur is a very low cost operator. So their break-even cost is at $26 a barrel WTI. And as many of you know, WTI today is $63, strengthened very significantly over the last month or so. And they also have a very, very low operating and transport cost of $10 a barrel, which is one of the lowest in the industry in Canada. This business with Black Spur generates some tremendous free cash flow at 3,000 barrels a day of production, and at $53 WTI, it delivers $24 million of operating cash flow in 2021. At the moment, as I mentioned earlier, oil prices are at $63, so there's tremendous upside that will also be added on top of these numbers. This opportunity came to us through a combination of unfortunate events for Black Spur. One was obviously COVID, and second was their major bank in Canada, major lender, National Bank of Canada, had a large lending facility outstanding, which they decided they wanted to have reduced. And we will be doing a capital raise of around $30-odd million, and those funds will be used to reduce the National Bank of Canada's loan facility from $43 million as it currently sits to $13 million. And National Bank will then give us a redraw facility up to $20 million to provide us additional working capital. So I don't think that if National Bank had actually not demanded a reduction of its loan facility, we would be able to acquire this asset. And I think, as many of you know, many Australian companies have gone to Canada buying mineral assets over the last 12 months and succeeded very well, because the Canadian equity markets are only now just starting to focus again on natural resources. The other thing that is important with this business that we're acquiring with Black Spur is that they have built all the infrastructure necessary to operate at 5,500 barrels a day, and they also have infrastructure to grow the business to 10,000 barrels a day. They originally, pre-COVID, invested over $200 million in these assets to build out pads, storage facilities, pipelines, other infrastructure, so that when they had tested these well locations and demonstrated that they had sufficient reserves to grow the business, they could then just continue to drill more wells one after the other, really in a harvest mode. But unfortunately, COVID, as we know, sent the oil price down in March, April. It was a bit of a shock to people that took time to recover. And then the bank then demanded a repayment of, or a reduction of, its loan facility. Next slide, please. So as I said, the transaction is very simple. We're acquiring 100% of Black Spur via a plan of arrangement through the Canadian courts. We will be undertaking an equity placement of $34 million, at 0.7%. There will be a priority offer to existing shareholders, and we will be undertaking an institutional raise. The combined market capitalisation post-transaction will be around 66 million dollars Aussie, and on many metrics comparing ourselves to Aussie-listed E&P companies and other Canadian-listed E&P companies, that's at the lower end of the quartile. And we do expect to close in April 2021. The consideration is a combination of cash and shares that's being paid to Black Spur. It's a combination of, it'll be 12.1 million dollars in shares of Calima issued to Black Spur and 4.9 million dollars in cash. The reason that there's a combination of cash and shares is Black Spur is in effect an unlisted public company in Canada. It has nearly 500 shareholders, and it was set up with a lifespan of 7 years. So it's at the final end of its lifespan. Some of its private equity owners required a cash exit, and many of the existing investors wanted to remain with the story because their entry price is 4 times the current transaction value that we are undertaking this deal at. There's also a contingent consideration tied to their working capital. At the moment, Black Spur is generating significant free capital each month, and as they generate more free capital and there's less debt on the business, we'll be issuing additional shares, potentially up to $3.2 million. And as I said, there will be at least $7 or $8 million of working capital in the business to undertake quite an aggressive drilling program. We intend to drill 1 well a month, a minimum of 1 well a month for the next 18 months. Ownership's going to be quite simple. New money coming in owns about 53% of the business, and the existing shareholders from both Calima and Black Spur around 23% each. Quite frankly, the new money coming in the story is getting a great deal. I was an investor at 1.8 cents previously. I was an investor at 4.5, and I will be following my money in this transaction at 0.7 of a cent. Parties associated with my family group will be underwriting via a firm offer $2 million of the raise. We have approval from the board of directors of Calima and Black Spur. We have 70% acceptance from Black Spur shareholders, which under Canadian rules means that this deal is fait accompli and we have all the necessary approvals. We just have to go through the court process of a scheme of arrangement in Canada. Next slide, thank you. Just to give you an idea of location, the Black Spur assets, the Thorsby and Brooks assets to the north and south of Calgary, very conventional, shallow wells, easy access, year-round access in oil and gas land that's been producing oil and gas for 25 years, 30 years actually, so we see no problems there. We're in the north of the Montney Formation. That blue outlined area is the Montney. We have taken acreage. We have 66,000 acres up there. And as I said, as you can see from the coastline with LNG Canada, we anticipated that there would be a revaluation of the gas reserves in the Montney as there was in Queensland many, many years ago when the LNG terminals were built in Queensland. Unfortunately, the US sort of stymied that for us at the time because the US unconventional production ramped up very quickly over the last 5 years, as you know. They weren't focused on profit, they were focused on production and reserve base. They forced the gas price down, which actually forced our share price down. The other thing that's important to note about the Brooks and Thorsby assets is there's extremely low technical risk. All the technical risk is being taken out of the reserve base that sits there today, and they have a very low decline rate of 22%. Next, thank you. I think many of you know this slide already. Henry Hub's gone up, AECO gas prices have gone up, WTI prices have gone up, and most importantly, the Aussie dollar's gone up in the last year. Aussie dollar's strengthened 10%. The oil and West Texas Intermediate has gone from 45 since we started negotiating this transaction in November to 63. Gas prices again have risen. So we believe going forward, despite my support of lithium stocks out there, everything that we have in our office, every computer, every desk, every glass, there's petroleum products used in everything that we live with today. We're not going to be removing that, and I still, for one, would be preferring to fly an aeroplane based on a jet engine rather than on batteries at this stage. So just me, but we'll see what happens. Next slide, thank you. Just to give you an idea of the cash flow sensitivities that this business has, you'll see in the blue, the dark blue, that's based on 3,000 barrels a day of production, which is where we will be in the next few months with Black Spur. and the grey is based on 5,500 barrels a day of production, which is where the facilities in the infrastructure are already built out to cope. So if you go and look at the middle slide, and actually it's quite hard to see down the bottom, at $50 WTI, this business generates at 3,000 barrels a day, $23 million of operating cash flow, and at 5,500 barrels a day, it generates $44 million of operating cash flow. So we've been very lucky in bringing this transaction together in with Calima. We will be working together with the Black Spurs team. Jordan Keever will be running the combined business for us, and we actually have a solid Canadian operating team with a diversification of longer-term gas assets with large resource and short-term cash flow production coming from the Black Spurs assets. Most importantly, if you go and look at the slide to the right, so let me just, excuse me for a minute, the slide to the right is $55 WTI. We're going to have to change that font. So at $55 WTI, at 3,000 barrels a day, we're producing $27 million of free cash flow. And at 5,500 barrels a day, at 55 WTI, we're producing $52 million of free cash flow Canadian, which is on parity to the Aussie. And as I mentioned earlier, WTI today is $63. Next slide, thank you. So today, where's our strategy? What's our vision? What are we trying to achieve? As I mentioned, continue the development, bring it up to 3,000 BOE a day very quickly based on the Brooks and Thorsby assets. Commence the 24-well drilling program, virtually one well a month minimum for 18 months. Grow very quickly to 5,500 barrels a day at the Brooks and Thorsby. Work strategically on our Montney acreage to joint venture with others or to work on an FRD ourselves, and to reduce the net debt that's remaining from the remaining residual facility with National Bank of Canada down to $5 million Canadian. Longer term, we're going to go from 5,000 barrels a day up to 10,000. We're going to look at production from the Montney of up to 11,000 barrels a day, and we're going to turn ourselves into a real emerging mid-tier oil and gas company focused on proven basins in Canada and accessing Australian capital markets. Importantly, the Canadian market for small junior resource companies is still broken. There's a number of bolt-on acquisitions that we can do from adjoining tenements and ground positions where the producers are producing 500, 600, 700 barrels a day. So not only will we grow organically, we will have a number of bolt-on acquisitions. Next slide, thank you. Just quickly, you can see the Calima lands on the left on the photo. That's development ready. We have all approvals to bring that into production. You'll see we have the Tommy Lakes facilities, which is on care and maintenance. That's a facility we acquired last year from Enerplus. Replacement value is $85 million. And what that does for us is that connects us to the gas grid in Canada, which means that when we build a 13-kilometre pipeline from the Calima land to Tommy Lakes, we'll be able to deliver the gas directly into the network. And as I mentioned here, with the Brooks and Thorsby assets by Black Spurs, they've invested over $200 million in their assets over the last 7 years, and we are actually consolidating together with those with their shareholders, and we'll have around 26 million barrels of 2P reserves. Next slide, thank you. Here, just some of the combined resource reserve statements is probably a little difficult to read, but I think the key takeaway from this slide is break-even costs of $26 WTI, high netbacks, generate significant free cash flow, and as I said, a large proved and probable reserve base, or 2P reserve base, sitting there of 22.5 million barrels, and our contingent unrisked resource of 192 million barrels in a Tier 1 jurisdiction in Canada. Next slide, thank you. Here's the Brooks, just to give an outline of the acreage. You can see from black lines, there's the pipelines that have been built. You can see the barrels, the facilities that are in place. But most importantly, this is a reserve base that's been delineated by Black Spurs over the last 7 years. So this is really a harvest mode. It is not exploring. It is actually developing proven locations. The wells are cheap. They're less than $1 million. At $55 WTI, the wells have a payback of 4 months. They have an IRR of over 500%. We've been extremely lucky in the timing with the recovery in the energy prices. So this asset's just going to be a very valuable asset that's going to deliver significant cash flow. Next slide, please. This is the Thorsby asset. This again is a conventional play. Well costs here are slightly higher. They're around $2 million, yet they can still be drilled in a month. There's nothing, they're conventional. They do require fracking, but the wells have very high porosity and permeability, and they flow extremely well. We are currently in the process of scheduling 2 wells to be drilled in early March. And when we come back on to the boards in mid-April, we'll have flow rates from those 2 wells, which we would anticipate based on type curves that have currently been in place for the last 50 odd wells that Black Spurs drilled. They'll deliver 300 or 400 barrels a day to start with. Next slide, thank you. Here, as I mentioned, this is sort of a breakdown of where we're looking in our growth phase. Currently 2,600 growing to 5,500. And as I said, small strategic acquisitions and incremental developments from the existing asset base that we have. We have tremendous book reserves already. As I said, you'll see the large inventory position. We've got 147 sunburst and blackonotic locations at Brooks. We've got 89 locations at the Sparky and Nisku. Those have already been booked. They're already in the reserve statement. So in effect, this is just a harvest mode. It's development drilling. Next slide, thank you. The Montney acreage, as I said, where we are, the green area is our 10-year retention leases. The yellow areas are our exploration leases that we're still holding. You can see the Tommy Lakes facilities to the north of that in green. You'll see the outline of the pipeline. As I said, the Tommy Lakes facilities are on care and maintenance. They're capable of handling 11,000 barrels a day. We need AECO gas prices consistently above $2.50 to make an investment decision or an FID decision to move forward with the development of our Calima lands in the Montney position. Gas prices today are $2.70, $2.80. They've been over $3, but we would have to see a very strong forward curve of really over $3 for us to make an FID decision. But really what our objective is to partner and joint venture with other regional players. Next slide. And this will give you an example of what's happening in the Montney. Last year, there was a large consolidation. Tourmaline went and acquired Polar Star. Canadian Natural acquired Painted Pony for $400 odd million. ConocoPhillips acquired Kelt for $500 million odd. And all these major players are basically consolidating their Montney acreage to work to deliver gas into the US and most importantly to the LNG industry in Canada. The 2 major independents left are ourselves in yellow and the yellow blob to the south of us, which is owned by a company called Seguero, and they've invested, I think, approximately $600 odd million today, drilling about 50 wells. Next slide. One of the things that we are focused on at Black Spurs is obviously ESG and their carbon footprint. One thing that's happening in Canada is the LNG facilities that LNG Canada are building are going to have the lowest CO2 emission per tonne of LNG. The liquefaction process is going to be powered by hydroelectricity. Obviously, liquefying the gas in a cooler climate versus a warmer climate in Australia requires less energy. The Montney has lower greenhouse gas emissions from its operating base. So really LNG Canada with its partners will be a very low CO2 emitter going forward. And also Black Spur has its own technology too, which is H2 Sweet, which also lowers its CO2 emissions. So it's something that we are focusing on and we want to actually expand upon. Next slide, thank you. As I said, the management team will be a combination of both the Black Spur team and the Calima team. Jordan Keeble, who was the founder of Black Spur, will be leading the combined business going forward. We've got Braden Basir as the CFO, Dawn Casey, Michael Dobovich, who's been driving our business and managing our assets, is going to be a key part of the team, together with Aaron and Mark. And the board will bring on 2 Black Spur directors, and it will remain with myself, Alan, and Brett Lawrence. Next slide, thank you. So as I said, we're going to be undertaking a $34 million raise. Of that, $5 million will be, as a minimum, will be allocated to existing shareholders on a priority basis and retail shareholders through a prospectus. That $5 million will be underwritten through a firm commitment, of which entities associated with myself will be doing 2 million of the 5, and we also have another 3 locked up. We already have a good part of the book done already for the equity placement, so we hope that we'll be able to close this transaction sometime mid to late next week, and have the stock back on the boards in April when the Canadian courts approve the consolidation and the scheme of arrangement. Next slide, thank you. So as I said, this is the timetable. Trading halt's been in place for some time, and as I said, the objective is to run through the relevant dates, which are all compliance driven, and basically once we have the scheme of arrangement approved by the Canadian courts, come back on the boards. We will have a large number of shares on issue. We will initially let the capital structure remain at around 9.5 billion shares in issue, and once the stock settles down and investors see an equilibrium in the share price, we'll then make a decision on a consolidation, but I would imagine that will be 3 to 6 months post-listing. Next slide, thank you, and I think that should be the last slide. And that's the history of Black Spur, if any of you are interested, from its formation in 2012 up to 2020. I think the most important thing is in 2017, pre-COVID, they were producing 4,300 barrels a day, and they actually peaked at over 5,000 barrels a day. So with that said, I'll close the presentation and answer any questions if I may.
Yeah, thanks, Glenn. We're out of time, but we'll keep going because we've kept the audience all the way through. So there's obviously some interest in the deal here. Who's actually running the placement? There's a question in that regard.
The placement's going to be run by Evolution Securities.
Right.
They will be running the institutional component of the placement. We have a number of existing high net worth shareholders who have already committed to, quite frankly, unfortunately, average down as I'm doing. I committed a large amount of funds at 1.8 cents and I'm averaging down at 0.7, but Evolution is running that. And there are a number of brokers under the placement that will be working with Evolution.
And I mean, it sounds like a very strategic and opportunistic acquisition. Was it your kind of access to funding that helped you beat off competitors?
Well, it was the access to, I think, a stronger equity market in Australia. The Canadian equity market for sub 10,000 barrel a day producers really isn't back there yet. Look, we took a bit of a risk. We put $1 million non-refundable deposit down earlier this month in this transaction as we were about to close. I think we also just had a bit of courage.
Yeah, good on you. I mean, it's a contrarian play at the moment, oil and gas. But one of the questions is, you've kind of got a wide range in terms of barrels per day. There's 3,000 to 5,000, and there's big change in numbers. Do you have any kind of historical data to suggest where that level will be?
Look, today Black Spur is producing 2,624 barrels a day of oil equivalent, because some component of that's gas. We know the infrastructure is in place to handle a minimum of 5,500, and with a couple $1 million, it will handle 10,000 barrels a day. We know there's reserves in excess of 20 million barrels, and we know there's 1P reserves in excess of 15 million barrels. So this is just a harvest mode. So we do not see any challenge in going from 2,600 to 5,500. It's just drilling the wells. And each, as I said, the Brooks wells are less than $1 million, and the Thorsby wells are around $2 million. And that's tied in and connected. A Brooks well will pay itself off in 4 months.
There's a question here. What are your views on pipeline capacity constraints in Alberta? Do they impact on Black Spur's operations?
No. Black Spur, in terms of its southern operations, is very close to the US border. A lot of that actually all is trucked or railroad across. And in terms of their other assets, no, there's plenty of demand for the product that Black Spur is producing, and we do not see any pipeline capacity issues at all.
And finally, in regards to the US, there's an analyst online here who's asked, does the US blocking some oil pipelines keep Canadian liquid price discounts high? And how quickly can Canadian LNG ramp up production and demand for natural gas?
Okay, I think the answer to that question is Canadian oil trades at a discount to US oil, predominantly because of the transport issues and also its API. So there's a differential between WTI and Western Canadian Selective. Used to historically be $15 a barrel. It's now $12 a barrel. So we don't see any, we actually see the differential reducing because the US refineries are wanting the product that the Canadian oil and gas industry is delivering. So that differentials, so a couple of things that's happened in our favor since we've actually been negotiating this transaction. And we started this in September, October, signed a heads of agreement, non-binding heads of agreement in November. The Aussie dollar over the last year has gone from 0.9 to 1 for the Canadian dollar. West Texas Intermediate's gone from 45 to 63, and the differential between West Texas and the Western Canadian Select has reduced from $15 to 13. So everything on those metrics is in our favor, and all these numbers that we're producing are based on historical numbers. So there's more leverage in this transaction that we haven't shown. And in terms of LNG, LNG Canada is operated by Shell, Petronas partners, Kogas, and some of the Chinese. They're building an LNG facility on the basis that each partner has to find their own gas, and a number of those partners in LNG Canada have not sourced the gas going forward. The Montney currently produces about 8.5 BCF of gas a day. LNG Canada will take about 2.5 BCF a day when it's operational. So we can only see the Montney gas prices around Station 2 and ACO actually increasing, not decreasing. But that's probably 18 months to 2 years away.